Back in March, several banks failed for what was called illiquidity and deposit flight. Signature, Silicon Valley Bank, and First Republic were liquidated by the FDIC. To stem the tide, the Fed produced a new banking program called the Bank Term Funding Program, or BTFP. For those unfamiliar with the program, this allowed for certain banks to get loans from the Fed for up to a 1-year duration. What's different about this program than the discount window or repo is that the loans were based on the par value of their bonds and not the market value of their bonds. This helped the banks avoid having to liquidate their bonds at a loss if the banks faced any kind of liquidity needs. This may help them avert any potential crisis. It also increased their costs of funding. The interest on the bonds will not cover the interest charged by the Fed, and this will hurt potential earnings. So the banks are faced with Treasury portfolio losses and higher costs if they use the BTFP program. In addition, there's fierce competition for their deposits. Both institutions offering money market rates and U.S. government bonds are yielding hundreds of basis points higher than the banks can afford to pay their depositors. This has led to deposit flight for banks.